So we can start.
Okay, so guys, let us go ahead and take on an example in the from the chapter Advanced Capital Budgeting Decisions. So this particular example is on expected value method, and this sum is extremely important from examination standpoint. And those are writing CA Final Number 24, just focus, okay, especially for them. Now let us go ahead and take on this question that reads Venkatesh Limited. Yes, ma'am.
Yes, sir. Venkatesh Limited is always discarding old lines and introducing new lines of products and is considering at present 3 alternative promotional plans for ushering in new products.
Okay.
Various combinations of prices, development expenditure and promotional outlays are involved in these plans. High, medium and low forecast of revenues under each plan have been formulated and their respective probabilities of occurrence have been estimated.
Okay.
Now their budgeted revenues and probabilities along with other relevant data are summarized as under.
Okay. Now let us read for plan 1. Okay.
Yes, sir. We have 3
Now
plans.
they given the 3 possible sales for each of the 3 plans. There are 3 plans. Okay. There are 3 ways you can promote your product. Say for example, plan 1, let us say it is social media marketing. And then plan 2, let us say you choose media advertisement. And plan 3, let's assume that you are sponsoring some sporting event, right?
Yes.
Yes.
So budgeted revenue with probability, all are rupees in lakhs.
Rupees and lakhs.
So high probability, it's a 30 lakh sales and 0.3 probability.
Okay.
And for medium, it is 20 lakh sales and 0.3 probability. And for low, it is 5 lakh sales and 0.4 probability.
So basically, high is nothing but optimistic. And then medium is most likely. And low is supposed to be pessimistic.
Yes, sir.
That is in case, the sales are wonderful, your product really takes off, then you'll sell rupees 30 lakh worth of goods. And what is the chance of that happening? Is 0.3 or say 30% chance. Or in case sales are moderate, it's going to be rupees 20 lakh and the chance is 0.3. And then in case sales don't take off, product is going to tank, okay, then sales will be 5 lakh. And what is the chance of that happening? 0.4. Now, if you add up all the 3 probabilities, you'll get what? 1. So 0.3 plus 0.3 plus 0.4 in all 1. These are the 3 possibilities. And for plan 2, what are the numbers given, ma?
It is 24 lakh, 0.2 probability. Okay. For medium, it is 20 lakh and 0.7 probability.
Okay.
And for low, it is 15 lakh and 0.1 probability.
And 0.1 probability. And then for plan 3?
Plan 3, it is 50 lakh, 0.2 probability.
Okay.
25 lakh, 0.5 probability.
Okay.
And for low, it is 0 and 0.3 probability.
Oh, 0 sales.
Yeah.
And the chance of that happening?
Is 0.3.
Is 0.30% chance. Okay. Next.
Yeah. So the variable cost as percentage of revenue is given.
How much for plan 1?
Plan 1, it is 60%.
That means the variable cost is 60% of sales. That means the balance 40% represents contribution to sales. And for plan 2?
It is 75%.
That means 25% is your contribution to sales ratio. Next.
Then 70% for plan 3.
That means 30% is your contribution margin to sales.
So initial investments, it is 25 lakh, 20 lakh and 24 lakh.
Okay, initial outlay, that's the amount you're going to spend on promotion is how much? 25 lakh, 20 lakh and 24 lakh.
Then life in years, 8 years for all the 3 cases.
The product will last for how many years? 8 years. Next.
The company's cost of capital is 12% and the income tax rate is 40%.
What is the tax rate? 40%.
Sorry, 40%.
And then?
Cost of capital is 12%.
Is 12%. Next.
So investment in promotional programs will be amortized by the straight line method.
They should have given will be amortized on straight line basis for tax purpose. They must have given that. Because you all know that as per Ind AS 38, the amount we spend on sales promotion will be recognized as an expense when incurred. We debit our profit and loss account. Yes.
Yes.
So that means this amortization is only for tax purpose. 8 years it can be amortized. Next.
The company will have net taxable income each year, regardless of the success or failure of the new product.
What is the meaning? Even if we make a loss on this new product launched, there will be some taxable income or profit from other products which are currently sold by the company, right?
Yes,
Next.
Number 1, substantiating with figures, make a detailed analysis and find out which of the promotional plans is expected to be the most profitable.
Now, you have been asked to find the most profitable plan. You can calculate the net present value because they're given the cost of capital. And then decide which one gives the highest net present value. Next.
Number 2, in the worst event, which of the plans would result in maximizing the profits?
Maximizing the
Profits.
That is in case the worst
Event
occurs. Okay, that is the second question.
Yes.
Now let us go ahead and take on the first subdivision.
Yes, sir.
Now I want people to make some calculations in your notebook. Please take a notebook and jot down this. Now let us calculate the expected sales for all the 3 plans. Okay.
Yes.
We'll do for plan 1 first.
Yes, sir.
Now for plan 1 is going to be rupees 30 lakh into how much? 0.3 plus rupees 20 lakh into 0.3 plus 5 lakh into 0.4. So what is 30 lakh into 0.3? 9 lakh. And what is 20 lakh into 0.3? 6 lakh.
6 lakh.
And 5 lakh into 0.4?
2 lakh.
Is 2 lakh. Add up all the 3, how much you get?
It is
In all, you get 17 lakh rupees is your expected sales. Or you can say that is supposed to be the average. That is a weighted average sales. Now, when I say average, I am referring to the weighted average. And here, what are the weights? 0.3, 0.3 and 0.4. Very good. Probability weighted average, right? Yes. Is rupees 17 lakh. And you are supposed to work out for plan 2 and plan 3 as well. Let's take plan 2, okay?
Yes, sir.
Now, plan 2, tell me what is the sales mark? So, it is 20.
1 minute, I'll take the
Let's go to the question. No issues at all. Now, people can have a look at the question.
So, it is 24 lakh, 20 lakh and 15 lakh.
And 15 lakh. The chance is 0.2,
0.2, 0.7, 0.1.
Okay, just calculate 24 lakh into
0.24 lakh,
into 0.2 is 4 lakh 80,000.
Yes, sir.
And then it is rupees 20 lakh into 0.7.
Yes, sir.
Which is 14 lakh.
14 lakh.
And then 15 lakh into
15 lakh into 0.1.
1 lakh.
So it is 1,50,000.
If you add up all the 3,
yes, sir.
Okay, you'll get the expected
20 lakh 30,000 is
and that is expected sales for plan 2. And you're going to do the same thing for plan 3 as well, right?
Yes, sir. So for your high, it is 50 lakh into 0.2. So
which
10
is
lakh.
10 lakh.
Yeah. So and for medium, it is 25 lakh into 0.5.
Into
so
0.5, 12 lakh and 50,000.
And last, it is 0 into 0.3
is 0.
So 0.
Okay, so
So
the
it adds
total
up to 22 lakh and 50,000.
is your expected sales. Is that clear?
Yes, sir.
Now there are 2 ways of calculating the contribution number. I'll just do for plan 1 alone, okay?
Yes, sir.
For plan 1, you tell me what is a variable cost given?
Given 60%. As 60%.
Now tell me what is 60% of 17 lakh, which is 10 lakh and 20,000. Please make a note.
Yes, sir.
So what is 17 lakh minus 10 lakh and 20,000?
Yes, sir.
Is 6 lakh and 80,000. That is your contribution. Is that clear?
So 6 lakh 80,000 is contribution.
Is your contribution. Is that clear?
And contribution is 40%.
40%. So I can do the same thing for plan 2 also.
Yes, sir.
I know rupees 20 lakh and 30,000 is my expected sales. On that, I can take 75% and find the variable cost and then subtract it.
Or straight away take 20
Or I
lakhs.
can take, very good, 25% on 20 lakh and 30,000.
Yeah, it is 5 lakh.
7,500 is my contribution directly I'll get.
Yes, sir.
I can do the same plan 3 also.
Yeah, that is 30%.
Either I can take 70% of 22 lakh and 50,000 variable cost and subtract it, or I can take 22 lakh and 50,000 into 30%. I'll get the contribution directly. Is that clear?
Yes, sir.
Okay. Now that is one thing. Okay, we discussed. So please jot down this in your notebook as we discuss. Okay.
Yes, sir.
Then what I will do, let me calculate the amortization expense. For plan 1, you want to spend 25 lakh on social media marketing, right?
Yes, sir.
At time 0. And they say very clearly it can be amortized over how many years? 8
Straight
years.
line basis, 8 years.
8 years straight line. Now what are you going to do? Divide a 25 lakh by 8 years. It is going to be rupees 3,12,500
Yes, so 25 lakh divided by
divided by 8 years, which is equal to rupees 3,12,500 is a
plan 1.
amortizing plan 1.
Yes, sir.
Okay.
Less
For plan 2, plan 2, what are you going to do? You can divide 20 lakh by 8 years, which will work out to rupees 2,50,000 per annum.
Yes, sir.
For plan 3, it will be 24 lakh by 8 years,
So 3
rupees 3 lakh each year.
Yes.
Is that fine?
Yes, sir.
Now let us go to the solution now. Now you're going to see the solution on the screen. Okay.
Yeah.
Now let us read for all the 3 plans. Okay.
Yes, sir.
So particulars, then
Plan
the 3.
1, plan 2, plan 3.
Exactly. Plan 1, think of social media marketing. Plan 2, think of the media advertisement. And then for plan 3, let's assume you're going to sponsor some sporting event, right?
Yes.
As a Baiju's sponsored FIFA World Cup, right?
Yeah.
That's it. To promote their service, or you can say product or whatever, right?
Yes.
Now let us go ahead and take on the solution. Yes, ma'am.
Yes, the first budgeted revenue with probabilities they calculated.
They found how much?
So the total
Plan 1, 17 lakh.
Plan 2, 20 lakh 30,000 and plan 2, 22 lakh 50,000.
Remember, these are the 3 promotional plans for introducing a particular product. Okay. You can either go for plan 1, plan 2 or plan 3. So 17 lakh and then 20 lakh and 30,000 and 22 lakh and 50,000. Next, less.
So then the contribution, no, they did not less. They straight away calculate
See,
contribution.
they straight away show on the contribution. If you want, you can show less variable cost, right? But here they're taken straight away. 40% or 17 lakh. And people should not. So 40% income tax rate, note that. It's only a coincidence, right? Here it's 40% PV ratio. Or I can say contribution to sales ratio, which is also known as PV ratio, right?
Yeah.
Go back to your cost accounting days, fine. And 6 lakh and 80,000 and 20 lakh 30,000 into 25%, 5 lakh 7,500. Under plan 3, 22 lakh and 50,000 into 30%, which is 6 lakh and 75,000. Now from that minus
amortization.
Exactly. So each 3 lakh, that is 3 lakh 12,500 for plan 1. For plan 2, 2 lakh and 50,000 per annum. And for plan 3, 3 lakh. And once you minus this amount, you get your profit before taxation. How much?
3 lakh 67,500 for plan 1.
And then
2 lakh 57,500 for plan 2.
Okay.
And 3 lakh 75,000 for plan 3.
Very good. And less income tax at 40% for all the 3 plans. Doesn't matter. Income tax 40%, right?
Yes, sir.
So you minus 40% tax. And tell me the profit after tax.
Profit after tax 2 lakh 20,500,
Okay.
1 lakh 54,500 and 2 lakh 25,000.
Now add back amortization, which is actually nothing but what? It's a non-cash item. Therefore, we add back to find the CFAT. How much?
312,500, 2 lakh 50,000 and 3 lakh.
And after adding, how much you get?
So that is yearly cash inflow 5,33,000 for plan 1.
5,33,000 is a annual CFAT. That is a per annum CFAT. What is CFAT? Cash flows after tax. So that is a cash inflow after tax. Under plan 1, 5,33,000 each year. Under plan 2, how much?
4,04,500.
And then under plan 3?
5,25,000.
Very good. Now what you can do, if you want, if you have all the time in the world, you can do this. 5,33,000 into first year factor. Again 5,33,000 the second year factor. Like that you can do for 8 years. Or instead what you can do, you can find the annuity factor at a 12% discount rate for 8 years. You can find the annuity factor.
Yes.
Which will work out to 4.9676. Nothing but adding up all the discount factors at 12% discount rate for how many years?
8 years.
8 years. Is that fine?
Yes, sir.
Okay. You add up all the 8 years factor and you get the annuity factor 4.9676. You multiply 5,33,000. Okay, take that number. That into 4.9676. How much you get?
26,47,731.
And that minus 25 lakh initial outlay will give you 1,47,731. That is a positive net present value. And you can also calculate the profitability index. You can divide a 26,47,000 blah 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 by 25 lakh. Works out to
1.059.
That is a profitability index. If you want, do this. Otherwise, you just find the net present value and then comment. No problem. Okay. And what about plan 2?
So plan 2.
It is 5 lakh.
Yeah.
What is your
4,04,500 is the CFAT.
Take that number. That into 4.9676. How much?
20,09,394.
And divide, from that you subtract 20 lakh initial outlay, you get the net present value, very small amount,
9,394.
And also calculate the profitability index.
1.005.
And do that for plan 3. For plan 3, what is a CFAT?
CFAT is 5,25,000.
And that into 4.9676.
26,07,990.
Minus initial outlay 24 lakh.
So you get net present value 2,07,990.
Now divide
6,07,990
by 24 lakh.
You get 1.087.
Now you can choose a plan
3
because that has a highest net present value. And happens to also what highest profitability index. But remember one thing, always you go by net present value. No, that's going to maximize the shareholders' wealth. Okay, yes. That is the objective. Yes.
Yes, sir. So plan 3 has the highest present value index and also highest NPV, hence most profitable.
Most profitable is plan 3. Always decide based on the highest net present value. If you want, you can also add this comment, also has a highest present value index or profitability index. Is that clear?
Yes, sir.
So guys, now we shall go ahead and take on the second subdivision. That is in the, what is that? The worst case scenario. That is the meaning. Yes. The worst case scenario. What if the worst event occurs? In that event, now which of the 3 plans will minimize your loss or maximize your profits? Is that fine?
Yes, sir.
So now we shall go ahead and take on the second subdivision. Now when they say a worst event occurs, now tell me what is the worst sales for plan 1? 5 lakh.
It is 5 lakh.
For plan 2?
15 lakh.
15 lakh rupees.
And for plan
3 is a big 0. So goose egg. Okay. It's a 0 sales. That's a goose egg. Okay.
Yes.
So now let us go ahead and take on for plan 1.
Yes.
So if suppose 5 lakh sales, people ask, sir, should I do 5 lakh into a probability? No, because The worst event
Occurs.
occurs means what? The product has failed and you're able to sell only 5 lakh rupees worth of goods. So take 5 lakh. What is 60% variable cost?
Yeah.
3 lakh. What is 5 lakh minus 3 lakh? 2 lakh is your contribution.
Yes.
Or what you can do, 5 lakh into what? Into 40% is 2 lakh. This 40% not the probability.
Contribution.
The contribution margin, the ratio, right?
Yes, sir.
That is 2 lakh rupees. For plan 2, 15 lakh into 25%.
25%.
How much?
3 lakh 70.
3 lakh 75,000. Have you shown that?
Yes, sir.
And then for plan 3,
0.
it is 0, 0, right? It is 0 into
30%.
into 30% is 0. Now from this, less your amortization is going to be 3,12,500,
2 lakh 50,000.
2,50,000
And 3 lakh.
and 3 lakh. And when you reduce, you get a loss before tax for plan 1,
Yeah.
which is rupees 1,12,500.
500.
And plan 2, there is a profit.
1 lakh 25,000.
And for plan 3, again, there's a loss of 3 lakh. Now, please remember, even though there is a loss in plan 1, there will be a tax saving because of this loss. The reason is what? This loss of 1,12,500 will be set off against some taxable profits from other products which are currently sold by the company.
Yes.
Thereby reducing a tax liability, there will be a tax saving. There will be a tax relief. Therefore, what you should do? What is a 40% tax rate on that loss?
1,12,500 loss.
Which is 45,000 is a tax saving positive. And then for plan 2, since there is a profit, right, you have to pay tax.
50,000.
50,000. For plan 3, again, there will be a tax saving of how much?
1,20,000.
1,20,000 tax saving. So now find the loss or profit after tax. So 1,12,500 negative, but plus 45,000 is how much?
67,500 negative.
Very good.
Then 75,000 positive.
Okay.
Then 1,80,000 negative.
1,80,000 negative. Now please add back the non-cash expenditure. 3,12,500, 2,50,000 and 3 lakh. And balance how much you get?
2,45,000, 3,25,000 and 1,20,000.
These are the cash inflows after tax per annum. Annual CF 80.
Yes, sir.
For 8 years it will flow. So what you should now take rupees 2,45,000 for plan 1 annual CF 80. That into 4.9676 will give the present value of all the future cash inflows. How much?
12,17,062.
And minus initial outlay rupees 25 lakh. That is a negative net present value. How much?
12,82,938.
Okay. And plan 2, take 75. How much?
75,000.
75 is it?
Amortization 2,50,000. So 3,25,000 annual cash inflow.
That into 4.9676.
So you get 16,14,470.
Minus initial outlay 20 lakh.
So
you get a
negative
loss.
3,85,530.
And plan 3 also what?
Also negative. Sir.
Negative.
1,20,000
1,20,000 into 4.9676.
5,96,120.
Minus initial outlay rupees
24
24 lakh. That's a huge negative
18,03,888.
Okay. So what happened? Let us say I failed in all the subjects. Okay, 3 subjects. I know it's a very depressing thought. Let's say I got some 38 in FR. I got 35 in AFM. I got 30 in auditing. In this, which one I got the highest? FR, 38, right? At least that is the best of what? The 3 papers. Like that, all the 3 plans what? Resulted in what? A negative net present value. Now tell me which has the lowest negative net present value.
3,85,530.
So therefore plan 2 is recommended in case you foresee what? The worst
Case scenario.
Worst event happening, the best one will be plan 2. Yes, ma, read the analysis.
From the above calculation, it is observed that negative NPV is the lowest in case of plan 2. Hence, it is comparatively better.
Comparatively better. You get it, huh?
Yes, sir.
Now, guys, a very important sum from examination standpoint. Please go through this example. Okay.
Yes, sir.
So, good luck for your examination. I'll post some more videos, right? Some more sums I'll be doing in AFM. Okay.
Yes.
But please go through this example really well. Okay. Good luck.
Thank you.